My projection by year end is between $2,250 and about $3,200. And that was based upon doing what's called a Fibonacci extension, which is basically putting retracement on its head. And that is my forecast for 2024. So I am exceedingly bullish. One other thing that I think is critical to where we see gold go over the next couple of years is dollar strength or weakness. And so recently, in the big picture, we've seen the dollar hit 107 on the dollar index and slowly decline.
Bloomberg Commodity strategist and other leading experts have predicted that gold prices could rise by 50% in 2024. According to analysts, gold is forecasted to reach $2,700 during the first half of 2024 and eventually hit $3,000 by the end of the year. Gary Wagner, an expert in charts and commodity forecast, is confident about bullish year-end projections for gold, roughly up to $3,200. Meanwhile, Wagner stresses the need to watch the dollar's performance for insights into gold's future direction. Surprisingly, over the past 5 years, gold and the US dollar have been rising in tandem. Surges in the price of gold this year have been explained by a few macroeconomic factors, including rising global debt levels and the effects from the China-US trade war. In his analysis, Gary Wagner highlights the recent strengthening of the dollar and its impact on gold prices. He believes there will be more weakness in the dollar amid approaching resistance. As the dollar index shows signs of increasing, investors will be paying more attention to any potential changes in its value in the upcoming weeks. He foresees a brief dip in gold prices, highlighting the significance of the 38.6% retracement level at $2,049. However, he anticipates a subsequent bullish trend for gold in the long term. Gold prices sank on Wednesday, weighed down by rising treasury rates and the US dollar, while gold rose 14.6% on the year, defying expectations amid a high interest rate environment and outpacing commodities, bonds, and emerging market stocks. Now, we present the clips of Gary Wagner's insights from his recent interview with Kitco News. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
The relationship between gold and the dollar is 100% of a negative correlation. It's inverse simply because gold is paired against the dollar in terms of its value. So when the dollar rises, gold will go down an equivalent percentage amount. And as you can see from this chart, again, it's a daily. And if we look back to July of 2023, the dollar index was roughly at 99. From there, it skyrocketed up to over 107. Now, it has been at 114. It has been higher, but this is relative to looking at the dollar index over time, a pretty high value. And then we saw it come down really from October. The same time gold began to run up, we saw the dollar come down. It broke through a key level at around the 78% retracement right in here. This two-day pattern that I'm pointing to is known as a piercing line. And a piercing line is simply when you have a defined downtrend, you have a large red candle, which we get here. That's followed by a green candle. And again, a green candle opens and closes higher. But in this case, it opened below the closing price of the prior candle, and it needs to close at or above the midpoint, which it did. You do not actually act on that unless you have what's called a confirming candle, which is on the following day. It's a green candle with a higher high and a higher low. So we did get that buy signal, but we are now right at a potential resistance area, which again is the 61.8% fib retracement at about 102.50. I believe that longer term, we could see more weakness in the dollar. Daily candlestick chart of gold. And what I have plotted basically is a Fibonacci retracement. And the reason for doing that is as this market hit this high, and of course, this is back at the beginning of December 4th on a Monday, it came down with a pretty strong correction to approximately 1985, and then began to cycle higher, moving as high as about, well over 2000. But once the new year started, we saw some weakness in the market. Today is a strong day down. And so what these dashed lines here represent different Fibonacci important levels to watch. This one here, which is where the current pricing is at, 2049, is based on a 38.6% retracement. Typically, when you look at Fibonacci, what we're looking at is, first of all, his sequence, which is a very easy formula. You start with 0 and 1, you add them, you get 1. Then you go 1 plus 1 equals 2, 2 plus 1 equals 3, and so forth. And all of our viewers are familiar with that when they think about a Nautilus shell, the way it revolves. And the reason that is such an important technique is that the relationship between each of those numbers is 0.618% or 1.618%. To give you a visual illustration, it's a blueprint of nature. So when you look at my hand, for example, this digit right here compared to this digit is compressed by 0.618, 0.618. So it's nature's way of growth, so to speak. And the financial markets picked it up years ago and found some real relevancy in it. So we're looking at where could gold drop to, because my sense is this will be a short-term correction, not that deep, and it will return to a bullish demeanor. So if it breaks through this level at 2048, the next level I would look at is 50%, which is not a fib number, but used. That's at 2018, and a deep retracement would come down to about 1987. And I'm not expecting it to go that deep. But that, in essence, is how we use Fibonacci retracements.
In the interview, Wagner states how gold reacts to rising and falling interest rates. He mentions the Fed plan for 2024 to 2026 to reduce inflation to 2%. Describing it as a multi-year process. Despite a recent moderation in inflation indicated by CPI data, gold's investment appeal endures. Its historical role as an inflation hedge, portfolio diversification benefits, resilience in global uncertainties, and unique supply-demand dynamics make gold a compelling asset. Wagner underscores that silver is historically considered as the little sister of gold. Despite the current futures trading at $23, Wagner expresses a belief that silver has the potential to double. Amongst its 5-year predictions, it forecasted that silver prices could range from $18 to $50 in 2024. This depends on the level of inflation, interest rates, U.S. dollar strength, industrial demand, and investor sentiment. Furthermore, he mentions Fed policy, geopolitical factors, and the U.S. dollar as primary determinants shaping gold's trajectory. Let's get back to the interview.
We talked about it briefly. Was Fed monetary policy changing from quantitative easing to from quantitative tightening to easing? And the reason that's important is gold is very sensitive to interest rates. Interest rates moving up create a bearish undertone for it. Interest rates going down is bullish for gold. And the reason for that is gold doesn't yield any interest on it. So it becomes more of a favorable asset to hold during times of low fixed income returns. That is going to be a process that it happens over 3 years, because the Federal Reserve itself projected 24, 25, and 26 and how they're going to bring that down and bring down inflation, because, of course, their ultimate target is to get inflation to a 2% level. So that's exceedingly important, and that will be a multi-year process. One other thing that I think is critical to where we see gold go over the next couple of years is dollar strength or weakness. And so recently, in the big picture, we've seen the dollar hit 107 on the dollar index and slowly decline. It's been exceedingly strong. We'll look at a chart whenever you ask me to, but exceedingly strong over the last 3 days. However, what is different now than we have seen maybe 10 years ago is countries organizing together, BRICS, which is a series of countries that are attempting to take the dollar and dethrone it from its status as the dominant currency for global trade. And that goes into oil because oil is traded in petrodollars. In fact, Iran and Russia signed an agreement about a week ago that they would now trade and sell oil back and forth in their local currencies. Of course, that would have a negative effect on the dollar. So it's going to be Federal Reserve monetary policy. It's going to be geopolitical landscape, dollar strength or weakness. To me, are the primary factors that I'm looking at currently. Key differences between gold and silver. When I started in the industry, silver was the little sister of gold, so to speak, and they both tended to move in tandem. They both were sensitive to inflation. They were both sensitive to geopolitical risk. They were both sensitive to risk on or risk off, how the equities markets were doing. However, we saw silver go to an all-time record high at about $50 the first time gold hit above 1900, middle of 2011. And then on the subsequent new price highs in gold, silver kind of fizzled out. It found a trading range that finds resistance at around $30. And so when you ask, do I think it's going to double? Futures right now are trading at $23.20. That would be about $43. I would like to believe yes. Historically speaking and looking at the technical data, silver has been unable to do that. Now, something has to kind of give. Many people talk about that there's a scarcity in silver. I'm not privileged to that data, but if that's the case, that would be highly supportive of it. I am looking for silver to move higher by the end of the year, but it first needs to take out $26 per ounce.
Given economic conditions and political tensions, most experts agree that gold prices will rise in 2024 as more and more consumers seek a safe spot to store their wealth. Considering the potential factors influencing gold's trajectory, what are your thoughts on the future outlook for gold investments? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.